Welcome back to another episode of the Paper Gain Show. I'm Johnathan Rankin, joined by my amazing co-host, Matt Magee. Matt, how are you doing today?
I'm doing great. Looking forward to diving in.
And we have a lot to talk about today. We're going to talk about what's going on in the markets right now. We're also going to touch on some of the most common questions that we get from a retirement planning standpoint. But I think we've got to start really with what's on everybody's mind, and that's the market, Matt. We're recording this on the afternoon after the close on Wednesday, the 30th, and we've had a rally over the past couple days, and it's been this nice relief rally. And I think the question that comes to mind for most people is: Are we out of the woods yet? Is the bottom in, or is there another shoe to drop? What are your thoughts, and what are you telling clients at this point?
Yeah, I would say the optimist in me definitely wants to say yes. The more realistic answer, I believe, is that's to be determined. I think it's anybody's guess. I've definitely never been in the business of predicting markets. That being said, you have to have an opinion on it, and so. I think it's still to be determined because I don't know, unless I've missed it, there haven't been any major tariff deals announced. Uh, and so I would say there's still some uncertainty of what those look like and how things will shake out over the next. I guess we're coming up on I mean, we're a little less than 30 days since they did that 90-day pause, so we still have at least 60 days until that pause is done. So I imagine it's going to take most of that time for the major ones, India, China. I'm not
Yeah,
sure where
but there
things.
are, I mean, but they're already coming up with these deals where they're saying, well, this company's immune, cell phones,
Yeah,
cars. It's like, okay, what's the next tariff actually going to be on? Just
yeah,
goods coming from the Timu factory. I mean, I think that's the part where I think that the big volatility that we saw and the initial shocks of, hey, this is a tariff, and they're going to be this drastic, and we're going to see these 5 to 6% sell-off days. I do think that that's probably over, but I think the shoe that we haven't seen drop yet is: how is this bleeding into the economy? I think a lot of people forget that we haven't had a recession in a real true. I don't count 2020. We haven't had a real recession in 15 years. Over that, and so a decade and a half. So people who are in their mid to late 20s, they haven't experienced a true recession, and so those things take time. Every time that we've had volatility, either in the market or economically, there's been the government to backstop us somehow, whether it was the Fed put, and or then you had a lot of spending bills. There was ways where they just infused the economy and the markets with liquidity, and that's the part where I don't think that there's that appetite next time. That's at least what concerns me. I hope I'm wrong, and I hope that there are deals that happen, but there's still tariffs at some point. That's got to impact something, right? I mean, we can't just go back to where things were at the beginning of the year and companies are just completely fine and the market's back at all-time highs, even though we've got, let's say, everything's a 10% tariff. I mean, it's still a cost somewhere, right?
Yeah, I don't know if you saw like Amazon tried to, or they announced that they were going to put the tariff cost on Amazon and which
As they should.
yeah, that makes
I
complete
love
sense.
that.
That lasted all of like 12 hours before they backed off that. Yeah,
I
I
wonder. I
mean,
wonder if they backed off it because I wonder if it was an issue from a political standpoint that that's a bad thing because it's just showing the tariffs. But I look at that from a consumer and think that's a good thing because remember in 2021 and 22 when inflation was going through the roof and all these companies raised prices because of quote unquote the inflation they were seeing, and you never actually knew. Okay, well, at a certain point, inflation subsided, but you
yeah.
kept your prices up here. You were just keeping the difference. And so I like the fact of, hey, this is the tariff surcharge. And when tariffs go away, guess what? The surcharge goes away. But now prices are going to be here. And even if the tariffs go away, I'm pretty doubtful that companies just go, well, we're charging here and they're comfortable paying it. Why do we need to reduce it down to here? So I like that, but I wish they would have kept that.
Yeah, I agree. As soon as I saw it, I tried to go to Amazon and see if I could see it, but obviously it never got to that point. But I agree with you. And to take a step back, it definitely does seem like the White House and the administration is making all these one-off exclusions like autos. They seem to be backing
Yeah.
off there. Uh, so I guess that's expected and probably part of what has led to the rally, if you will, the past 6, 7 days. And so I mean, it's also been interesting just all these airlines and automotive companies, as well as others, just pulling future guidance on the next quarter, remainder of the year.
See, and this is where my this see, and this is why it's such a tough market because there's certain aspects where you're bearish and certain aspects where you're bullish, and you just go, is this the CEO's way of just, let me pull guidance because that way, if I have a great quarter next year, I'll get this lift from that because we're really not seeing companies that are pulling guidance getting punished like we would have thought.
Yeah,
Initially you would have thought, hey, they're pulling guidance. Next thing you know, sell off in the stock. But I think that the street seems like yeah, that makes sense. You're pulling guidance and they're not punishing them for that. So if you're a company, you go, well, if I don't have to tell the investors what we're expecting in the
yeah,
next quarter,
I know.
we set our own bar and just say, hey, we pulled guidance and guess what? It was a better quarter than expected. So now we can hopefully get this pop to the upside. I don't know. It's such an interesting time, but that I've seen so many people and I've heard from so many people that during the worst of the volatility, they made a lot of dramatic changes. Whether they sold a bunch of stocks or they just made some major changes. So if let's say you were one of those people and you sold out of the market, and the market at one point, as you know, was down. The SP was down over 19% from its high. Nasdaq was down over 20, almost 24% from its high. And so you sold out, in the midst of that, and the market's rallied on you. What do you do now? Do you get back in or do you just sit on the silence? And what if like you said, what if the tariffs just there's deals that are created, we shoot back to all-time highs, recession avoided, what? So what if you're talking to someone that is pulled out of their investments because they're worried about all the volatility, the tariffs, the days where the market was down 5%, and now they're sitting on the sidelines in cash? What do they do?
Yeah, if it was me or a client of mine, what I would do is have a serious conversation about your overall risk tolerance and find a way to get back to something that you're comfortable with. That may include more downside protection funds or alternatives that uh, aren't marked daily if you're the type that and qualify and all of that, of course. But if you're the type that hates that intraday movement that stocks bring, maybe it's incorporating more alternatives. But really finding a way to get you back invested as soon as possible would be what I would typically do, unless the situation warrants otherwise. But that I think it really starts with a good conversation. Maybe you were 80, 90% equities, for example, just using an extreme case here, but looking at bringing that down to maybe 50% equities and layering in maybe 20% alternatives and then 30% fixed income, real estate, things
Well,
like that.
so if that person, let's say they were 70, 80, 90, and they were overextended on equities, but now
Right.
they're not even 50%, they're 100%. It's such it's one thing to sell. Selling is kind of the easy part. It's like you hit the button, okay, I'm out. Things fluctuate. It is what it is. It's when you get back in because when the market was down 5 or 6%, we look back at it. Those were the best days to get in.
Hmm.
But then the market's rallied and we're seemingly in a better position because people are coming to the table. The VIX is down from where it was. So on all the technical side, we're technically at a better point, which is what most people wait for, and that's the issue of going all in and all out on your investment
Yeah.
strategy, and that's why I always try to warn people: don't go all in or out. You
Yeah.
just can't time that. But if you're already out and you're trying to figure out what to do to get back in, it's never going to feel natural just to go 100% and say, hey, today, April 30th is the best day to buy into the market. Yeah, you've got to create a strategy and a discipline to say, okay, my target is X, whether that's 50, 60, 70, could be back to 80% in stocks, and I'm going to do that over a period of time. And you've got to be comfortable with that, and you've got to stick to it. But this is, I see a lot of people who do this that are self-directed and aren't necessarily working with an advisor to help them. But I know that these conversations happen when people are close to retirement. They're worried about their portfolio, and they go, "This is my nest egg. I got to live off this for the rest of my life, and I don't want to just see it go away because one person who's in the presidency wants to issue tariffs and cause our market to go haywire." So it's such an interesting and tough position if you've done any sort of big moves, but um, that's I would say you've got to at this point create a plan to get there.
Yeah, agree 100%. And last thing there is couldn't agree more on trying to eliminate those drastic moves in or out, uh, and and then you don't have to worry about timing getting back in because I've only seen this once or twice where somebody got out at the all-time like worst time in like March of 2020 and then didn't feel comfortable getting back in until later that year and missed the entire rally.
I
And
saw it happen in '08, '09. I watched
yeah,
people get out in '08, and I watched them still in cash in 2012, 2013. And a lot of it, I mean, maybe 2013 might have been a stretch, but I saw a lot of people who were sitting on the sidelines in 2011 and 2012 for sure. And because going through those periods, nobody believed that was the most underbelieved in market because it was all predicated on liquidity from the Fed. So nobody really bought into it, even though the market just kept reaching new highs. And it was so I've seen so many people hurt by that, and I'm hoping that's not you who's listening to this, but if it is, that's what I would do. Now, I want to there's a number of questions that we get as we talk to people who are focused on retirement, and one of them that's a consistent question that I know I get a lot, and I want to see your take is on the healthcare side.
uh-huh.
If you're retiring before 65, so before Medicare, how do you bridge that gap? What's the best way to do it? And then how do you plan for healthcare costs even in retirement? What do you say to someone who's focusing and worried about some of those things?
Yeah. So really, one, your options are somewhat limited. So from the research I've done and having these situations come up, really comes down to uh, do you have the ability, even if you retire, some plans offer the ability for executives or owners to stay on even after retirement. Uh, the follow on to that is Cobra for a short period of time. Go
Man,
on.
that Cobra's so expensive.
Yeah, but you're just protecting the catastrophic coverage. That's how I think about it. Go on a spouse's plan is another option. The ACA, the healthcare marketplace that everybody hates, at least where we're located in DFW. To my knowledge, I haven't looked this year, but I believe those are almost 100% HMOs, which everybody hates on. But I would say it's an option to protect the cancer, the car accident, I, I'm sure you've seen some catastrophic issues. Like I saw somebody last year that had a brain aneurysm 1 month before going on Medicare, and he didn't have the best insurance. So it can absolutely happen. So that's another option. There's like the health ministries that I've seen one or two people do where you pay into it. That's an option. And then the final option that I've seen a few people do, especially in that high net worth to ultra high net worth space, is if you have like a rental property or rental properties or some sort of like passive business like that. Uh, I've seen a few people set up a small plan as long as you can find a broker that helps set that up, which there's not as many of those that do because
Yeah.
it's typically two or a husband and wife or so it's not a ton of premium, but setting up a plan through like a LLC that you have and creating your own health plan. So really, those are the only options. The catastrophic coverage has effectively gone by the wayside, at least last time I looked.
Well, and I think I think
Me.
the biggest part about bridging isn't the fact that you've got to figure out which policy, whether it's Cobra, the exchange, the strategy of playing through an LLC. It's the plan of, hey, I've got this extra bill that, if you're married, you're probably looking at anywhere between 1,200 to, 1,800 if you're going to go with Cobra or the exchange. And you've got to work that into the financial planning side of it. I think that's where people go wrong is they think, well, today I'm spending $80,000, so I'm going to retire at 62. I'm going to spend the same amount and I'll be good to go, not factoring in, this additional cost. So if you're budging for that. And as we plan for clients, a lot of what we do for those under 65 is, we'll add a healthcare expense there for those few years to bridge until Medicare. So that way they know, okay, we've got money earmarked for this because it is a cost that you're going to have to take. Now, what's your take on long-term care insurance? Are you a, when does it make sense to insure? When does it make sense to self-fund? And how do you go about that? And what are your thoughts on like a hybrid or just the old traditional long-term care policy?
Yeah, I would say I definitely helped plenty of clients get it over the years, or people. I feel uh, like any insurance, it goes in cycles of how good the benefit to the upfront cost is. I don't feel like I've been doing it the past couple years just because it hasn't been as attractive. But that being said, plenty of people have them and we review them. But I would say where it's made a lot of sense is the single premium options where somebody is call it in their 50s to early 60s. That's typically, broadly speaking, a good time to do it. And if you have excess cash, especially if it's just sitting on the sidelines in a money market or and then it's just a leverage play of taking care of that future benefit while giving you some sort of death benefit if you don't utilize it. So situations like that I've seen make a lot of sense, but actually paying the monthly premium amount, I have not seen
Yeah.
near as much. And
I
then
think there
the
was so
second
much there's
part,
so much that people hated about those policies where it was the, hey, if I don't use it, I lose it type of thing. It was almost like term insurance where you're just paying this bill and if you don't need long-term care, the money was gone. And so
Mhm.
I think it causes a lot of people to, to really be just opposed to buying those. But I have seen scenarios where, the nobody wants to buy long-term care insurance. That's not the thing. I've never
Yeah.
seen in my entire, what Facebook's been around since what, 07, 08. I've never seen a social media post where someone's going like, look at this long-term care policy I bought. Like I'm just, celebrating this thing. Never seen it.
No.
So it's not the most exciting thing, but I've seen the other side where people didn't buy it are really wishing they did. And so,
Yeah.
if you have any history of anything in your family where there's medical issues, that's where it really makes sense to start thinking about it. It's the bill that nobody wants to pay on the front end for insurance, but it's definitely the bill you don't want to pay if you eventually need it. So I just want
Yeah.
to at least see what your thoughts are there. Um,
Yeah, I'll add two things to that. Uh, yeah, I've definitely seen predominantly it's uh, call it somebody that's in their 50s to 60s, and they start dealing with their parents who have long-term care, and they're seeing how much a facility costs. I've seen people be extremely grateful that their dad or mom bought that years ago and that it's paying for it. I've seen that scenario quite often.
yeah,
And then two, the self-funded part of the original question. Uh, I would say that depends wildly. I would say if your financial plan shows significant excess cash or liquid investments at your life expectancy in the excess of 2, 3, 4, 5 million plus. That's when hypothetically you get to the point where maybe it doesn't make as much sense to get it, that even if you get out there uh 20, 30 years from now, you're more than likely to have more than enough assets in your various other accounts to self-fund it.
yeah,
And oftentimes that, coupled with not having or maybe being fully invested or no significant uh, cash pile to do the single premium. Those two things coupled together usually lead to, or a little too old where, okay, you put 100,000 into this, but the benefit that the insurance company is giving you is not near as good as if it was in your 50s. So situations like that. So it's all wildly dependent on your situation, but the wanted to hit on that briefly.
yeah. I think that's a good point. But yeah, it's I think having that number that you feel confident in to be able to self insure is important. And really, I always like to run it within the financial plan of, let's say you do need, let's say because the worst case scenario is that one spouse needs it in a married couple, that one spouse
Yeah.
needs it, and then you've it's not like the other spouse who's living in the original home is just going to sit at home and watch free cable TV all day. They're going to want to still enjoy life. So there's expenses that go along with that. So now you've
Yeah.
got to see what does that do to the big financial picture. So it's really good ideas there. And I love your take on what you should be doing right now if you were one of those investors that pulled out. And I'm excited to see where the market leads us next
Likewise.
week when we get together. And for those, if this is your first time listening, thanks for being here. Make sure you hit that subscribe button. We're on all podcast platforms, and we enjoy doing this. And Matt, I look forward to it next week.
All right. See you then.
All right.